To talk more about what could be ahead for those micro E-minis and the S&P 500 E-minis, I'd like to bring in Jay Pestrichelli of ZEGA Financial. And what do you think of those micro E-minis, Jay?
You know, Abigail, I think they're a great product for the individual retail investor, right? Gets you into the futures market with not a lot of capital up front, doesn't put you too much notionally exposed. I think they're great for the individual.
Okay.
Yeah, it's a nice product, and they track pretty well to what the larger minis do.
Yeah, they certainly do. And you're bullish on the larger minis. Let's take a look at your weekly chart on the larger minis, suggesting that there could be some nice upside here for equity investors.
Yeah, exactly. So for us, we're long-term hedgers. We like to invest. We certainly like to hedge when volatility is low. It's a lot more effective to put on positions that will grow as the market moves higher. And so what we've charted here, there's a couple lines here that we're looking at where we are putting in a floor in our portfolio, but still giving us upside exposure if the market appreciates.
Got it. So can you explain those levels just a little bit more before we take a look at how you play it on the option side? Which
Absolutely,
is
absolutely. Yeah, so we are actually long puts at the 2,800 on the E-mini. So that kind of puts a floor in the portfolio, limits the amount that the market, regardless how far it drops, limits the amount that the position could lose. And then we actually end up being bullish where our break even just with the futures option positions by themselves is above about 30.90. So that's about a 3.5% appreciation, but that's the cost of being hedged. Which is actually, you know, our intention of limiting the downside but creating upside exposure for us.
And it's pretty interesting that where you have that limiting downside level, basically a stop is on that 40-week moving average or the 200-day moving average. And now let's take a look at the bullets on this, because that green line basically above that means that you're going to gain, but I'd like you to talk a little bit more about these details. Maximum gain. Unlimited.
Yeah, sure, absolutely. Yeah, so the details of the trade are here. We've got a long call and a short put. That is a synthetic long stock position, right? It means we're replicating being long the market, but it makes very good use of our exposure, meaning the cash that we have to lay out for it. And then this long put at 2,800 puts a floor in the portfolio. And so we really, our estimated loss is at, you know, only like a 4.5%. And then this 3.7% appreciation is where we start to make money. Now, the great thing about this trade versus, say, just going out and buying stock is we use very little capital to do this. And so if you could then take that freed up capital, put it into really a mildly risky, not even that risky bond portfolio, you can almost fully pay